Intel's stock does not move 9% in a day because of anything Intel did. It moved because the President of the United States said something. That is the market we are operating in right now, and understanding that dynamic is worth more than any technical chart. Today, 3 separate stories: an Intel-Apple chip partnership, a U.S.-Iran peace framework collapsing oil prices, and pre-jobless claims positioning driving the Dow higher, are converging into a single coherent picture of where institutional money is moving. The question is, are these moves a buying opportunity or a warning sign dressed up as good news? Let's start with the most striking move of the session. Intel surged approximately 9% after President Trump publicly stated that Intel had struck a chip design partnership with Apple. That single comment was enough to re-rate the stock by billions of dollars in market capitalization within hours. Now, before you read that as either bullish euphoria or political manipulation, step back and think about what it structurally means. Apple has for years been the most important case study in vertical integration in consumer electronics. When Apple moved to its own silicon, the M-series chips, it was widely seen as a death blow to Intel's relevance in the high-margin consumer segment. Intel's trajectory since then has been, to put it charitably, difficult. If a genuine partnership on U.S. chip design between Intel and Apple is real, and not merely a political statement, the implications are significant. It would suggest Apple is willing to re-engage domestic semiconductor manufacturing at a moment when geopolitical pressure to onshore chip production has never been higher. It would also signal that Intel's foundry ambitions, its bet that it can manufacture chips for other companies the way TSMC does, may have landed their most prestigious potential customer. The critical word here is if. A presidential comment is not a signed contract. Markets sometimes price in the announcement before the reality catches up. We have seen this pattern before. A high-profile statement drives a 9% gap, and then 6 months of execution risk follow. The actionable framework here is straightforward. If you are evaluating Intel as a position, the question is not whether the partnership is real. It is whether the market has now priced in a best-case outcome, leaving little room for the messy reality of semiconductor development timelines. SpaceX dropping 3% on the same day after a 3-day rally losing steam is a useful, contrasting data point. Momentum giveth, and momentum taketh away. On the same day Intel is surging, oil prices are falling. The reason, according to reporting from Al Jazeera, is that the United States and Iran have signed a framework agreement to end their conflict. If you have been paying attention to geopolitical risk premiums embedded in crude prices over the past several years, you understand why this matters structurally. When there is active tension involving Iran, one of the world's significant oil-producing nations, the market prices in a risk premium on crude. That premium is not about today's supply. It is about the probability of disruption to future supply through the Strait of Hormuz, one of the most critical choke points in global energy logistics. A credible de-escalation framework removes some of that premium, so oil falls. But here is the part worth thinking carefully about. Stocks are rallying at the same time. On the surface, that might seem contradictory. Energy stocks often move with oil. But the broader read is more nuanced. Lower oil prices are disinflationary. Disinflation, in the current rate environment, is precisely what equity markets want to see, because it increases the probability that the Federal Reserve has room to cut rates or hold steady rather than tighten further. This is the mechanism. Iran deal reduces oil risk premium. Oil prices fall. Inflation expectations ease. Equity risk appetite increases. Dow rises. Each link in that chain is logical, but each link is also fragile. A framework agreement is not a final treaty. Iran's domestic politics are not simple. Anyone positioning entirely around this peace dividend should be aware they are also positioning on geopolitical execution, which has a notoriously poor track record of following through on schedule. The actionable read: watch energy sector rotation carefully over the next 2 to 3 weeks. if oil continues to fall on genuine supply normalization expectations. Money historically rotates out of energy and into rate-sensitive sectors like utilities and real estate investment trusts. That rotation, if it begins, is a tradable pattern. Not financial advice, but a historically observable behavior worth tracking. The third thread running through today's session is the Dow rising ahead of the weekly jobless claims release. This is a pattern that sophisticated traders watch closely, because pre-data positioning in major indices is itself informational. Weekly initial jobless claims are one of the most real-time labor market indicators available. They are reported every Thursday, they are not revised dramatically, and they are one of the few high-frequency economic data points that the Federal Reserve watches with genuine attention. When the labor market is holding firm, meaning claims remain at historically moderate levels, it supports the narrative that the economy is not deteriorating rapidly, which in turn supports corporate earnings expectations. The fact that the Dow was already rising ahead of that release on June 18, 2026, tells you something about positioning. Institutional traders and quantitative funds were, in aggregate, betting on either a benign number or pricing, in the possibility that a stronger than expected labor market reading would reinforce the soft landing thesis that has been supporting equity valuations. Here is the subtlety that most retail investors miss entirely. The market does not wait for data. It prices in expectations of data and then reacts to the delta, the difference between what was expected and what actually printed. A jobless claims number that comes in exactly as expected on a day when the Dow was already rising can actually cause a slight pullback because the good news was already priced. Conversely, a worse than expected number on a day of pre-market optimism can cause a sharp reversal. The framework to internalize. Before any major economic data release, ask yourself not just what is the number likely to be, but what does the market's pre-data price action suggest has already been priced in. The gap between those two is where short-term risk actually lives. Today's session, taken as a whole, shows capital moving with conviction across multiple catalysts simultaneously. That is either the beginning of a broader risk-on rotation, or it is the kind of optimistic convergence that historically precedes a sharp retest. Keep watching the data. We opened with a question. Is today's market move a genuine opportunity or optimism dressed up as a signal? Here is the honest answer. It is both, depending on which position you are already in. Intel's 9% move, oil's decline on an Iran framework, and the Dow's pre-data bid all point in the same direction today. Markets this aligned across multiple catalysts deserve skepticism, not celebration. The follow-up question worth answering next. What happens to this entire thesis if the Iran framework stalls? Subscribe and we will be here when it does.